What's up, guys? I hope you're doing well. James here from jamesdforsyth.com. Continuing on with our going through of A Premiere on Money by John William Wright Patman, and as promised, talking about how money is created today. So pretty much typical thing, if you've watched any of my past videos about this book and kind of Patman's point of view, it's very government centric. And so essentially he says, but not the money supply. This is something which the government must decide about. If it did not do so, economic chaos would result, right? And so one thing that comes to mind, it's like he believes it's I see his point, I guess, to where maybe the government should be in charge of the money supply. It's kind of, it seems relevant, I guess you could say. But it's also like as if the private sector couldn't do the same thing. I mean, in the past, throughout history, they have. I think some would also argue that they still do now with the Federal Reserve, but that's kind of delving into the nuances between, like, how are you defining the Federal Reserve? Some say like a public-private partnership. Others say it's a government entity. It's an agency of Congress, whatever. There's enough discourse on that topic to make me want to look into it more and to kind of make some clarifications before I really kind of solidify what I think it is. Some say it's a cartel of private banks. There's merit. I think there's merit to all of those, to varying degrees, but that would have to be a separate video, and I need to do more research on that specifically. Probably include rereading the Federal Reserve Act, with that kind of keeping that in mind so that I don't get sidetracked with all the other stuff in there. Okay, so to continue, after all, money involves and always has involved something closely akin to faith. Sorry, it's dark and I can't read this Bible print. Which probably explains why in many past societies the money system has been in the hands of a priesthood, the subject of magical rites, and ceremonial services of the tribe's medicine man, right? And so the psychology of money is probably one of the most interesting things I've really actually tried to think about. Because it very is much of a faith-based system, especially now. It's essentially defined as such, where it's all based on credit, right? And so you're basically placing faith in your counterparty that they'll pay you back and that you will reciprocate some value, right? And so it's kind of the whole point of it now. But a lot of people know that money and kind of banking kind of started with gold, right, in some form. And so essentially in Western Europe during the 17th century, and some before, I don't remember exactly I can't say 1671 or whatever it would be, in which that it actually started in. But essentially it started with goldsmiths. And so with goldsmiths, I mean, their whole craft involves crafting gold into various objects, right? And they would use that to make things. And so they had a store of gold for their inventory. And so essentially people would start placing their gold, because at the time this was essentially the main form of money, main form of currency, I should say, without going into the argument of what is money exactly and trying to define that. So essentially the goldsmiths would hold other people's gold because it's in their best interest to keep it safe. And so they were deemed trustworthy because they're placing your gold with their own store of gold, which they have every incentive to keep safe, right? Because that is their livelihood. If they lose their gold, their business is over and that's it. So it's really where it started. And so essentially the goldsmiths would start to basically lend out receipts, just saying hey, I have this much of your gold, you're essentially depositing it with me, right, in a way. And so at some point people the depositors, for lack of a better term, of the gold would tend to lend and trade those receipts as a form of currency, right? Much like in, I believe it was the late 1700s, and maybe even all the way into the mid 1800s in America for tobacco, where they would do the same thing but with tobacco in warehouses. Yeah, it was a very similar thing. And it's kind of the whole form of, or kind of a prelude to paper money, or like a fiat currency, to where, I mean, it's kind of the same concept, but it's actually quote unquote backed by something. It's an actual receipt for gold in this case, or for tobacco in the other case. And so I guess you could argue that like the US dollar, especially when it was backed by gold, was essentially the same thing. It was sort of a, I don't know if you'd say it was a receipt, but it was more of a claim on something. So you could have a claim on some fungible part of gold. And I say fungible because it's not like you're going to get the exact same gold back that you deposited. Whereas if it was a receipt, it might be more likely. But then again, it depends on how different institutions work. Because I know there's some nowadays to where it's like, what is it, the Perth Mint? I think that if you deposit with them, you can decide how you want it deposited. So like if you get your own box to where you have your own stuff back if you withdraw, the exact same pieces of gold or silver that you put in. And then on the other hand, you can be like, okay, I don't really care about that, and for less of a holding charge or whatever, less, you have to pay less of a fee, and they basically just put it all in the same vault. And if you say you want 10 ounces of your gold back, they'll just give you 10 ounces, and not the 10 specific ounces you put in there. Of course, that depends on if you're doing numismatics or not. Okay, so basically with these receipts, this is, as you can probably tell, this quickly turned into a fractional reserve system, to where they would the goldsmiths would lend out more receipts than gold they had. And so he states, this gold, actually the certificates of ownership, the receipts that the goldsmiths gave the people when they deposited, being loaned by the goldsmith, was not his to lend. He did not own it. But so long as the calls for gold by the original depositors were so infrequent, the goldsmith felt he could lend without undue risk and earn interest on a certain portion of the deposited gold, right? So basically, it's fractional reserve banking. It's just, instead of a typical fiat currency, you're dealing with certificates of ownership for the gold in the vault, right? And then, yeah, all of this was based on the faith of the goldsmith, right? And so this actually, one of the big problems with this is the mere suspicion that the goldsmith did not have enough gold was normally enough to start a run, right? So like a bank run, almost exactly. And I think, you see, he quotes something, at one time a banker in Amsterdam, an important center of European goldsmith banking, proposed a law making it a hanging offense to start a run on a goldsmith. This immediately produced just such a run. Of course, the goldsmith could not pay, and the customers ended up hanging the goldsmith. So be careful what you ask for. So yeah. And a serious problem was posed because the goldsmith's money, his receipts, was usually acceptable only in the locality where he himself was known. So if you didn't know who this random guy was, I mean, you're not going to place faith in him, right? Much like how we had problems with banking in the mid 1800s or so, where it was rather localized, and you had settlement between banks was difficult, to say the least, because essentially banks would do the same thing in terms of pricing and counterparty risk, and they would actually discount checks from depositors. From, like, if you were writing a check from somewhere in Nevada, pick a place, and then the other bank that you were depositing to or transferring to was in, say, Florida. Well, those aren't, and I'm just picking random states for the concept, and basically the settlement between those was a pain, because I mean, we didn't have like the digital infrastructure and everything obviously back then, and so they would literally have to transfer, like say in like a horse-drawn carriage or whatever volt kind of thing they had back then, and they would have to settle that way for the transaction, which is a pain in the butt. And so they would discount that check to where, like, if the check was for 100, they would only actually like give like 95 or whatever. They would literally discount it, right? Okay. And you saw this specifically back then with his case, like the businessmen and traders, to make large transactions, would have to withdraw all of it and do it themselves, essentially, right? Okay, and now how does this kind of play into today, right? With bank reserves, and kind of, instead of gold as kind of the reserve base, you have something called bank reserves, which one way that I heard it described very well from Eurodollar University was like interbank tokens, because bank reserves can only be held by specific depository institutions who have reserve accounts at the Fed, right? And so there's like, you have to be eligible to do that. Not everyone can, right? And so you essentially have kind of like two layers, right? And so that they say, like, at the lower layer, you have the commercial banks, which is where like public checking accounts are held, like your checking account at, say, JP Morgan or whatever your bank is. And then on the layer above that, you have the Federal Reserve System, which is essentially a carbon copy of the bottom layer with commercial banks. It's just, instead of meaning the public's checking accounts, it's the checking accounts for the individual banks, their reserve accounts, right? And so from there, it's much the same dynamic in terms of making loans to increase the amount of bank reserves. Just how, like, your commercial bank, if you pull out a mortgage, will just create that money. They literally just credit it to your account, and then there you go. And when you pay it back, it destroys that commercial bank liabilities, your demand deposits, and so on. Yeah. And so, as he describes, reserves are money, just like any other money, with one distinction: they are deposits, demand deposits, owed to the commercial banks by the Federal Reserve. So same dynamic, just from a different perspective. That's part of the reason why the Federal Reserve is deemed the bank of banks, in some cases. And so, like I said, the dynamics are much the same. So when a bank borrows from the Federal Reserve, the Reserve increases the amount of the bank reserves on that, for that loan, and then the new bank reserves are basically created through that, right? And so when the Federal Reserve loans them money, it credits their reserve account, increases their bank reserves, so on, right? But the difference is, with these bank reserves, they're considered high-powered money, right? That's kind of another term for them, because they can essentially be multiplied by the commercial banks. And that's where the whole like reserve requirement comes in. Say it's 10%, and basically say the Federal Reserve credits $100 to JP Morgan's reserve account. And then JP Morgan can go and lend out 1,000. It's multiplied. Now, there's obviously laws and regulations and different metrics that kind of define exactly how much they can multiply that. Because if it's a 10% reserve requirement, it's not necessarily just going to be 100. There's other stuff at play. So, like, if people, because they have to be like, okay, what if someone withdraws from there? Is like, how does that change? And there's a bunch of other stuff into it. So it's not going to be exactly 10 to 1, but that's something else, right? Okay. And yeah, that's essentially it for bank reserves. I mean, they're really just for like settlement and transactions in between banks, is what I've noticed. And then you can essentially loan them up. And so that's one difference between the two layers of this system that he describes, where you have the Federal Reserve at the top. When they create money, bank reserves, it essentially can create a multiple of it, to where, like, they create it for the banks themselves, and then the banks then have the ability to multiply it further. They don't have to, but they have the ability to. And that's kind of an important distinction, because just because the amount of bank reserves increases doesn't necessarily mean the amount of money circulating in the real economy will. Because that means, for that to be the case, the commercial banks would also have to increase their lending, right? If they don't, then you can basically throw bank reserves to infinity, and it's not really going to have much of an effect in terms of the money in the real economy, right? Now it correlates because it increases the ability for the banks to increase their lending. But if they don't, for whatever reason, there you go, and that's it. Whereas if the banks just start creating more, there's only kind of one level. So that's part of the reason why that's part of the reason why bank reserves are considered high-powered money, is because they can literally be multiplied. Just like certain securities and stuff in like the repo market and other money markets can be rehypothecated and multiplied. You have, I think they call it a collateral multiplier, where it's the same collateral, like this, literally the same treasury bill is used for multiple, as collateral for multiple loans. And there's nuances in there, like because I know I think it's reverse repo with the Fed, and certain parts of, like, I think it's the tri-party repo market, like you can't rehypothecate the collateral, but there's other cases where you can, and then it depends on, is it fungible or not, and so on. There's different sections for a reason, but that's a rabbit hole that we don't need to get into in this video, right? And so, let's see, I have two final things right here, which essentially is just what I've already said when I started talking on my own. Yeah, that's it for this section. Cool. Okay, yeah. One of those things, it's like, I'll show you the actual cover to the book. I've already done it a few times, but it was only like a few bucks on Amazon, and like I said, it's an alternate point of view. It was written in the 1960s, but it gives a lot of technical things. I think I talked about this in a previous video, to where it's literally like question and answer. Like, it's a question and then he gives a paragraph or sometimes multiple pages of kind of a detailed answer. Like, for example, just flipping to a random page, how does Congress exercise its power to create money and to regulate its value? Paragraph. And then you got, what backs the US dollar? Paragraph. And it's just stuff like that. And what is the formula that determines the maximum amount of money and credit available to business and consumers? And then he's got like a whole page on that one, 3 pages or so. But yeah, it's definitely a nice little book to read. It seems to be rather relevant, even though it was only written in the 1960s. Like, there's a few points to where it's like, okay, maybe that's not as relevant anymore due to law changes or other things that might not be specific to the Federal Reserve. Like, he still references the FDIC limit to be, I think it was 100,000 at the time, whereas now it's 250,000. Small things like that, just kind of dating it a bit. But it's also like, I mean, it was written in the 1960s, and so that the concepts are the same, and that's really the reason why you should read the book. Is to understand the concepts, because I mean the numbers will change and a few other things and stuff, and there's some of it based on the intellectual merits itself. I think it's a great perspective to listen to. It's definitely different from what you normally hear, which is part of the reason why I got it. But anyways, I'll leave it there. So as always, if you have any questions or requests, comment and everything. It's a YouTube video, so we'll leave it there. Anyways, hope you guys have a good day, and I'll see you on the next one.